Hey, how's it going, everyone? My name is Amos, and a couple of you have commented on my videos asking if I could go over, what I look for when I analyze and dissect a company to figure out if it's a good company or if I should just avoid it like the plague. And on that note, that's something you should know about me is I've always been a man of the people. Right? If you want to see a specific type of video, I'm more likely than not gonna make that come to life. I'm gonna make it happen. And that's the perks of supporting a small YouTube channel, because when it comes to these big finance YouTubers that have hundreds of thousands of subscribers, when you comment on their videos, dude, they just straight up ignore you, right? On this channel, we do things differently, and I read every single comment. So with that said, let's go ahead and get into this video. So when it comes to analyzing a company, there's so many different factors, criterias, and things to take into account. Everybody has something that they're hyper-focused on, and their checklist looks really different. But in this video, I'm gonna go over what I care about. So the video itself is gonna be a step-by-step guide, or I guess kind of like a tutorial of what I am looking for. And no, I don't care if the company has big nipples or a small belly button. I don't care about stuff like that, okay? And it's gonna be a working example with Lockheed Martin, ticker symbol LMT. Because right now, this is a company that I have been eyeballing for years now. And I think the opportunity to finally jump in has presented itself. So I want to see whether or not I should do it on Monday, or I guess the stock market is not open on Monday, but Tuesday, if I should jump in or not. But before we go any further, I think you should know what you see on your screen right now. Call me cringe, call me silly, but I created a slide deck of my investing philosophy. That way, whenever I think about a prospective company or a potential investment that I want to add to my portfolio, I go over my investing slide deck to see if it aligns with my philosophy, if it's a business that I want to be a part of my portfolio or not. So first things first, when it comes to analyzing a company, you have to train your mindset to look at it as a business that is running real operations rather than just looking at a stock that has a market price associated with it. Oh my gosh, it used to be $100 6 months ago and now it's at $20. It must be cheap. If that's the way you handle your investment philosophies, dude, you need help. That's not the way you should go about it. The reason being is if you look at a company as if it's a business, then you can see for yourself whether or not that it's good or bad, if the financials make sense or not, or if the fundamentals look spectacular, or if they're declining year over year. If you take all of that into account and realize that it's a real business, then it makes the decision-making process that much easier. You're not gonna care if other people think that the company sucks because you did your own homework and your research to understand that it's absolutely undervalued and that it's a high-quality company. And it might sound silly, but in that investing philosophy slide deck that I have, I may or may not put this up on the Patreon if you guys want a copy of this, but I also cataloged a bunch of investing quotes, phrases, and sayings that make a lot of sense, right? It's fundamentally sound advice. And the reason why I said that earlier is because Peter Lynch said this: behind every stock is a company. Stocks aren't just ticker symbols. They represent a real underlying business that is running a real operation. So you're trying to figure out, is the business sound and high quality? Would you want to own a crappy business or a good one that is growing? Because if you only think about it as a stock, you're not going to care if the business itself is good or not. You just want to buy it because it's cheap now and hopefully it goes up. Dude, that is literally the definition of gambling. You're not investing. So my personal checklist on what I'm looking for in a stock, we have to replace that word stock with a business, because I have that mindset of I'm buying into a business. When you buy into it, you literally become a shareholder, which means you become an owner, a part owner with like the millions of other people out there of that company. And if you can't be a proud business owner of that company, then you shouldn't be going near their stock. Does that make sense? If you kind of agree with that, then we can go on with the rest of this video. And by the way, context really matters, because this checklist that we're doing right now, it just won't apply to a REIT. Because when we think about a real estate investment trust, things like Realty Income Corporation, the monthly dividend paying rate, you would look at things differently, same way that you would with growth companies. Now, in the context of LMT, Lockheed Martin, because this is a working example, I would categorize them as a very mature dividend paying stock. As such, I'll be paying close attention to their dividend profile, their free cash flow, and their margins. But there's also several other factors that I'm going to be taking into account. And by the way, if you stick to the very end, I'm going to be sharing with you what price that I think Lockheed Martin should be at right now, and then good prices to buy into Lockheed Martin. And then I'll also throw down a freaking criminally undervalued price to pick up shares of Lockheed Martin. So just stick around for the whole video, okay? The next thing that I try to do when evaluating a company is I try to assess their business model and whatever it is that they do. Because a sound advice from Peter Lynch is you should only invest into companies that you understand. If you don't know what it is that they do, you won't understand what's going on, especially when their stock price starts to fluctuate and is going through a volatile up and down kind of a dance. So in the case of Lockheed Martin, they're in the business of making fighter jet planes like what you see on your screen right now, and also the weapons that are equipped to the aircraft like the missiles. A jet plane doesn't just fly around for fun, right? They also shoot down their enemies with these like torpedo-like missiles. Pretty terrifying when you think about. And the catalyst that they have going for them in the future is their F-35 planes that they are currently building out right now in order to replace all the F-16s that are out there around the world. Speaking of which, there are over 400 orders on the backlog for these F-35s. It's up to Lockheed Martin to be good on their end of the bargain. They need to construct and build it out and test it out and then deliver it to their clients. In this case, it would be United States Air Force. And the price tag for a single F-35 aircraft is about $100 million. Yes, $100 million a piece, depending on the weapons that are equipped with it and the specifications. I know for the United States Navy, it'll cost them slightly more because the jets have to land on a carrier instead of a runway, which when you think about it, a fighter jet plane landing on a runway, that's cool, that's impressive. But landing on a freaking ship in the middle of the ocean, I have the highest respects for Navy pilots. My roommate in college ended up becoming a Navy fighter jet pilot. It's pretty phenomenal to think about what they can do. In my humble opinion, that might be unpopular, I think Navy jet pilots are slightly better than the United States Air Force pilots because of the fact that they have to take off and land on a carrier. Like, that's insane. And is the F-35 any good? Well, what you see on your screen right now is the first, demo flight of the F-35, and it's supposed to be the main fighting force, especially in the air, until the year 2070. So I think the investing thesis writes itself, and the F-35 seems to be a pretty good product. So who exactly is their customer? When you think about a potential business, you got to think about who can they sell their product or service to? Is it reoccurring revenue? Is the customers sticky? Are there other people encroaching upon their space? Do they have an economic moat? There's a lot of these things you need to take into account, right? So with Lockheed Martin, I would say their customer includes the Department of Defense, the DoD. That includes the United States Air Force, the Navy, Space Force, Marine Corps, and the United States Army. And the best part about this customer of theirs is that they have the biggest military budget on planet Earth. And then, of course, you need to think about our allied countries as well, because they're also going to be ordering these F-35s from Lockheed Martin. Take a look at your screen right now. Pay attention. Do you see how this freaking plane can literally take off and land like a helicopter? They could do a vertical takeoff, which I think is absolutely bonkers. That's going to change the name of the game for warfare, especially when you need to take out an entire city and just bomb the living crap out of it. Instead of needing 3 miles of a pavement road for them to land cleanly on, they can literally just land like a helicopter, refuel, and re-equip more missiles onto them they can take right back off to bomb more crap, which, when you think about it, is really terrifying. And I'm glad that this is the United States military instead of another fighting force having this type of technology. Something else that you want to consider is, will their product or service be relevant 10 years from now, 40 years from now? Well, for Lockheed Martin's case, when I thought about it, think about it, right? War is always going to be on the menu. When one war starts to end, another one starts to sprout right back up. And not only that, most developed countries, they do want to protect their citizens and their borders, right? And so to be able to defend yourself from enemies or threats, that's gonna be pretty important. At least it is for, places like Canada, the US, Germany, Mexico. Any developed country is going to want to invest into their military infrastructure. For other people, this might be aliens, right? Coming out of the ocean. If you're reasonable, that's probably what you're thinking. By the way, I went down this rabbit hole like 6 months ago. My goodness gracious, aliens are real and not enough people are talking about it. But anyways, to other people, that threat, that enemy, it could be China or Russia. So to sum it up, Lockheed Martin's business model revolves around war and having a capable air force to defend yourself against all threats. If you don't have an air force, then another country can just literally do aerial strikes against you all day long. Unless you have something like, what is it that Israel has? It's called like the Iron Dome. They have so many air defense artillery and missiles just set up where even if you do want to strike them, they'll literally just shoot your missiles right out of the sky, which I think is pretty crazy. But I think that only works because Israel's footprint and their landmass is really small. And so to defend their skies and their territory is not exactly too difficult when you think about it logistically. But for a country like the US, the landmass is like what? 200 times the size of Israel, maybe even 500 times the size of Israel. Setting up something like the Iron Dome is going to be really hard. And that's why we have United States Air Force bases located around the entire world. So at the end of the day, when you think about Lockheed Martin, they're associated with defending yourself in the military and war. And, to elaborate on the word war, it's a necessary evil, right? I would love to live in a world where there's no violence, where there's nothing crazy happening and we all just live in peace. But that's way too naive and optimistic thinking. Because history shows us that every so often, handful of years, 20 to 30 years, there's always a Hitler that comes out of nowhere trying to commit genocide. And so you need evil to fight evil. Does that make sense? So you might not agree with their business model and what they do in their industry, but it has to happen. We need people that are willing to sign up and put on a uniform and fight on behalf of the good in order to eliminate the evil and the darkness of this world. If you don't think for 1 second that evil exists, dude, you are way too naive. You really think just allowing the evil people to do whatever they want is going to allow them to be more peaceful? No. They never stop. Once they seize one country or eliminate one type of peoples or identities, they're going to move on and start eliminating even more people or take over more countries. And then they start turning into a dictatorship. And it's just, okay, whatever. So after I try to assess whether or not I understand that business and what it is that they do, then I move on to the next step, which are the numbers and the financials. Speaking of which, I leave money on the table. Knowing that, precious rare earth metals, they have the ability to 10x in the next, 50 to 100 years, but I just don't understand that business model or that industry. No matter how much I tried to understand, I just can't. And that's why I don't invest into precious rare earth metals. But when it comes to Lockheed Martin, I think it makes sense. I understand what they do, their political landscape, their biggest customers, their revenue model. I get it. So with that said, now let's go ahead and look at some metrics and criteria that I think are the most important. Kiss me beneath the milky twilight. By the way, that song has been stuck in my head. Yes, I'm a straight man in his 30s, but that song slaps. What can I say? Anyways, I created this scorecard to keep our thoughts organized, and so you can kind of follow along. And you can just open up whatever investing platform that you like to use. I personally like Yahoo Finance, Seeking Alpha, and Morningstar. But whatever platform makes your butthole happy, just use that one, okay? So currently right now, Lockheed Martin is trading roughly for about $423 a share. The first thing that I'm going to be taking a look at is their revenue. This is what investors refer to as the top line. For almost every single company, sector, industry, whatever it is, ideally you do want to see this be growing year over year. Now, how much you want to see it growing by, it depends. If it's a growth stock, you need to see this growing at a double-digit rate. But for a mature dividend-paying company like Lockheed Martin, single digits is usually enough. But at a bare minimum, you do need to see at least 2% growth year over year. And the perfect sweet spot is somewhere around 5 to 7%, especially for a mature company. So as of right now, their revenue is $71.04 billion a year, which I would argue that's a lot. And year over year, that grew by 5.14%. So when we think about their top line, I think it looks pretty good. Now remember, their revenue is usually going to be locked in by predetermined contracts with the DoD, and specifically with the United States Air Force, the Navy, and whatnot. So if you do want to see a double-digit growth number happening here, like instead of 5% year over year, something like 11%, then the X factor, that's going to be our international allies, because those contracts vary year to year. Their demand, their requests from Lockheed Martin is really going to vary. As things are right now, I would say their revenue picture looks pretty solid. And the next thing we're going to be looking at is the net income. This is what investors refer to as the bottom line. Essentially, how much profit is a company generating after you take into account all of the wages that you pay for the employees, the overhead costs to operate a factory, a warehouse, or whatever it is. So the bottom line. And by the way, for both the revenue and the net income, you can find it in the financials known as the income statement. Now, their bottom line right now is $5.336 billion. However, this is a big however, year over year, it decreased by 22.89%. Now, for a mature company, I think for me, the net income matters slightly more than the revenue itself, because sometimes the revenue kind of tops out depending on a whole list of factors, right? Like market saturation, maybe they have too many competitors, maybe they have loss of pricing power or declining demand. So revenue might not always be increasing year over year every single year for a very mature company. But for the net income, that is something that a company can focus on in order to be better year after year, because it shows that they're increasing their profitability, cost efficiency across the board, the way that they're doing things, economies of scale, the way to produce their product or service is really optimized. So for me to see a negative 22%, not good. However, I looked beyond the numbers to figure out what exactly is going on. So come to find out, in Q4, Lockheed Martin recorded $1.8 billion in charges related to classified programs at their missiles and aeronautics lines of business. And they can't disclose what exactly happened, but it impacted their overall operating profit, as you can see. However, from the sounds of it, I think this is going to be a one-time charge rather than something that's going to be happening quarter after quarter. So I think this right here is going to be a one-off, whereas the next year, it should be positive again. But as of right now, as things stand, this is a yellow flag. We can't entirely trust what a company says they're going to do is going to happen, right? Because the next following year, they could also run into unexpected costs that eat into their operating efficiency, and then their net income can drop even more. So the top line I thought was phenomenal. Their net income, I'm a little hesitant with a yellow flag waving around like a school crossing guard. Moving on, the next thing that I want to take a look at is their debt. And there's so many different ways to do it. However, when it comes to Lockheed Martin, I felt like the most appropriate way to measure their debt is through the debt to EBITDA ratio. It's a way for us to measure how much debt a company has relative to how much money they earn before, taking into account interest, taxes, and other expenses that they pay. Meaning how much money they earn per year in relation to how much debt that they have. A ratio of 3 or less is the standard. Anything above 4, and you do want to pump the brakes and be like, okay, this company has way too much debt right now. And as it stands, their total debt picture is kind of high. They have about $21.48 billion of debt. That's a lot, right? However, their EBITDA for this past fiscal year is not bad at all. It was $8.394 billion. And so when you do the math, you're going to divide the total debt by their EBITDA, which spits out a ratio of 2.55. In other words, it would take Lockheed Martin 2.5 years to pay off all of their total debt if all else remains the same. And if they just earn money flat year over year, their operations, their revenue, their net income, if everything just stays the same, it would be a 2.5. So it tells me that this is not bad at all. This is pretty good. And something that you do want to take into account is that when it comes to defense companies, they often, not always, but often hold higher leverage than other industries because it's a very capital intensive business. You need to be spending a lot of money on R&D to build out factories and infrastructure in order to support your capabilities in building out, shipyards, submarines, jet planes, and whatnot. So it's not that we're giving them a pass, but it's so that we understand them better. So this number right here might be terrifying to see $21 billion of total debt, but it's just the way it is with their industry. It's not something to be too scared about. It's the exact same thing when it comes to utilities, clothing brands, and REITs. That's why some people only want to invest into software companies because their overhead costs are so much lower. They don't need to think about CapEx and capital expenditures in order to grow their business and operations. But what I just said right there is false because in the past 2 weeks, Google and Microsoft disclosed that they have to increase their CapEx spending in order to build more cloud data centers. And the Wall Street investors hated to hear it. But for the most part, they don't spend as much in CapEx like when it comes to defense contracting companies do. Now, the next metric that I look at is their operating margin. It basically tells us how much profit they make from their operations. You want to see a number that is stable, 20% year over year, or for it to be trending in the right direction, which means it's growing, right? So going from 20% to 21% and then 22%. But in the case of Lockheed Martin, right now their operating margin is 9.8%, which is a decrease quarter after quarter by 12%. But I think it's associated with that one-time, $1.8 billion of unexpected costs associated with running their operations. So that makes sense. And the next metric that I care about is going to be the free cash flow. Essentially, it shows us how much cash is left over when you take into account what it is that they need to spend in order to run their operations. So it shows us, is this company profitable? Are they generating cash? This is very important. In the context of a very mature company, if they don't have positive free cash flow, every single red flag should be raised to the sky as if you're meeting your ex. There's a lot of things not to like if you see a negative free cash flow. And for Lockheed Martin, their free cash flow right now is sitting at $5.287 billion, which unfortunately year over year is a decrease of 15%. Not a good thing. And that's why that $1.8 billion was a bigger impact than investors initially thought. And that's why I think it's one of the reasons as to why Lockheed Martin is going on a sell-off right now. Based on my research and hypothesis, I think Lockheed Martin is going on a sell-off right now because their margins decreased because of that $1.8 billion setback. But number two, I also think because of the DOGE committee and their ramifications and implications of what's happening to the government right now. Last I heard, when I read an article on Wall Street Journal, almost every single government agency is firing and letting go of all probationary employees across the board, right? Department of Energy, Department of Veteran Affairs. And I think the rhetoric and narrative on Wall Street is that if the DOGE committee is going to be decreasing government spending across the board, eventually this might also bleed into the Department of Defense. But believe it or not, the DoD is one of the few agencies that are exempt from all of this reducing the budget and cutting people and firing people. The DoD is not impacted. However, Wall Street thinks that's not going to be the case 6 months from now. So I guess time will tell. But remember, Lockheed Martin has contracts in place with the United States Air Force, and they have 400 F-35s as back orders where they have to produce, build out, and once they deliver it, they get paid. So they do have a steady and reliable revenue source, at least for the short term. And who knows, 20 years from now, it might not be like that, but it is the way that it is right now. And also in the context of free cash flow, something that I also like to do is consider their free cash flow per share. And for Lockheed Martin, that's going to be $22.10. The reason why I like to look at it is because a lot of companies, they like to dilute the shareholders by issuing more shares. I know, I lost you already, but the important thing to keep in mind is when you break down their financials and fundamentals down to the per share level, then you can see on a basis of how many shares that are outstanding on the stock market is the value of whatever it is that you're trying to measure. So in the context of rates, you shouldn't just look at the AFFO. You should be looking at the AFFO per share to see whether or not the REIT itself is growing in their operations and their quote-unquote free cash flow. Likewise, in the context of mature companies, I look at the free cash flow per share to assess what is going on with their free cash flow picture year over year broken down to their share level. And something else that I want to mention about free cash flow on why it's so important is because it's also an indicator of if a company can sustain, share buybacks or to even grow their dividend. Yes, I understand that the money to pay for a dividend comes out of the retained earnings, but the free cash flow is a huge component of that, right? Okay, anyways, the next metric that I look at is share buybacks. Is the company buying back shares? So right now, there is currently 239 million shares outstanding, which sounds like a lot. However, what you should know is that Lockheed Martin has bought back 4.78% of the shares outstanding quarter over quarter. And since 2013, this is something they have been doing every single 90 days. Every 3 months, they buy back more shares, which means if you start out with like 500 million shares outstanding and eventually through share buybacks, it reduces down to 100 million shares, that means on a fundamental level, each share of Lockheed Martin that you own has more quality over a quantity. You're not being diluted. But more importantly, when you think about it on a financial level and on an earnings perspective, when you buy back the shares, it artificially pumps and boosts the EPS growth. Because if you dilute the shareholders by issuing more shares, then the earnings per share situation is going to really depend on your free cash flow and net income. But if you're buying back the shares, then it allows you to have an increased, quote unquote, increased EPS. Hopefully that makes sense. And the next metric that I take into account, but I really don't like, some investors, they put way too much weight and consideration into the PE ratio. For me, I don't really care too much. I think it's something that I look at, maybe like 1% of the decision-making process, but anything more than 1% is too much, in my opinion, for me. Okay, that's me. And when it comes to their forward PE ratio, meaning how much are they worth 1 year out from now, their trading multiple is a 15.5. And the reason why I want to mention this is because their historical PE ratio is somewhere around the range of 14 to an 18. So when you think about it on a timeline of history, right now, their valuation is towards the lower end of their historical PE ratio, right? And I also say that because you do not want to buy into a defense company when the PE ratio or the trading multiple is way too overvalued or stretched. So if you know their historical trading multiple is somewhere between a 14 and an 18, and currently Lockheed Martin is trading for like a 27 or a 28, then you know that the market is being way too greedy about this company, no matter how solid you think they are. That's when I just put this company onto my watch list and I patiently wait. I wait days, weeks, months, years for the price to come down and for the market to stop being so greedy with the company so that I can buy into it at a very good price. Never, ever overpay for a defensive stock. Okay? Defensive stocks always trade normally at a teens PE ratio, depending on the context of which defense company we're talking about. but Lockheed Martin, Huntington Ingalls, usually in the teens area. So for me, when I see a 15.5, I think this is a really good time right now. Or it might not be, right? At the end of the video, I'll explain my thought process. And the next thing that I'd like to take a look at is what is the sentiment surrounding this company? Meaning, what is the stock price in relation to their 365-day pattern? Are they near their highest prices ever? Are they near the bottom? Are they going through a sell-off? And it's a factor that I like to think about, not because I think past performance is indicative of future gains, but you can gauge from it what the stock price usually trades for about. So if you know that the company trades for around $100 to $200, then you know there's a line of support. Not always, okay? Don't be a smart, wise ass. Not always, but they have a line of support at the $100 range, and then there's a line of resistance at around the $200 range. And then also you can kind of figure out your exit strategy. So if you know the company has the ability to hit $195, $199, or even $200 a share, this is getting into day trading, speculative, technical analysis nonsense that I only apply maybe like also 1% to my decision-making process, but it's something that I like to have in my toolkit because I understand how day traders do their stuff. But anyways, if you know there's a natural line of resistance at $200, meaning whenever it reaches that price, the stock market and all of their little algorithms and on their computers, they literally start selling out of the company to crash it right back down to like 180, 170. Then a day trader would look at that and be like, I'm going to sell this company when it reaches 199. You give a $1 margin of safety so that you can hit it on the mark. All that to say, there's a lot of things you can take away from the 365-day price pattern. So in the past 1 year, the highest price that Lockheed Martin reached was $618.95. And as you see right here, they're currently trading for about $423. When you think about their 1 year low, well, this is going to surprise you, but it was this past Friday when they reached $419.70 in the middle of the day. They closed the day at $423, but in the middle of the day, they reached $419. So as I look at this number right here of $419 a share, that means it's either the company has reached their bottom or they have the potential to free fall and reach a new low. They could go down to like 370, 350, you don't know. So this right here is going to be a very scary number to see as you go into the next week or the next month. If Lockheed Martin hits that number and keeps bouncing back up, then you can realize that there's a line of support there. Without understanding Bollinger Bands, RSI, and the simple moving average on a very basic high level, that's exactly what I try to articulate. Anyways, try not to think too much of anything that I just said regarding the 1 year price. It's just a way for us to understand, are they near their highest price ever or the lowest price ever? I feel more comfortable with you taking that away instead of all of the other day trading nonsense that I just spoke into existence. Anyways, the next thing that I like to take into account is the CAGR. It's the compound annual growth rate, meaning through the stock price appreciation, share buybacks, and all the dividends that are paid out, what is your return on investment year over year? It's a way where I can figure out whether or not this company, through their DNA, through their history, through their timeline, whether or not they are a compounder. Because think about it, you want your money to be growing in a cash flow generating machine, right? Do you want to put your money into a company that you know 10 years later it's going to be worth less? Probably not, right? Unless of course you like pain and shoving pineapples right up your booty hole. If that excites you, then you probably like that. But for normal people like you and me, if we put $1,000 into a company in an XYZ amount of years, we would like to see $10,000, right? For that money to grow and compound, because the money we invested into was into a business itself that is operating efficiently and with good fundamentals. That's why we're doing what we are doing right now. So all that to say, I take the CAGR into account because I care about a company's performance in the stock market. One thing that I hate to do is invest into a company that has a terrible CAGR, because it shows me if I invest into this company, I'm literally going to be losing my money in terms of opportunity cost into another winner. Why invest into a loser when there's a lot of high quality companies out there? Okay? Anyways, with Lockheed Martin, their CAGR is 13.41%. meaning in the past 20 years, on average, your money would have grown at a rate of 13.4% year over year. I don't know about you, but for me, for my money to grow at a rate of 13% every year, dude, I'll take it. Sign me up. That sounds like fun, dude. And then, of course, the dividend profile. So right now, their dividend yield is sitting at 3.12%. For me, the minimum standard for an acceptable dividend yield for a mature company that pays a dividend is 3%. So I would agree that Lockheed Martin is a decent dividend-paying company with a pretty juicy CAGR so far. We're not done yet, but that's the assessment that I can make so far. And the dividend payout ratio tells us whether or not the dividend is sustainable. Like, can they afford to do it? Worst comes to worst, there's companies out there that want to keep their status of being a dividend payer. You know, if they have a record of paying it 20, 30, 40 years and then growing it also for 20, 30, 40 years, they'll do whatever it takes in order to sustain that dividend. Meaning, they're going to jeopardize their operations and growth, take on more leverage, take on loans so that they can pay out that dividend. It's ridiculous. I think it's stupid. All that to say, you want to see a dividend payout ratio that's at least 80% or less. In a perfect world, you want to see a company's dividend payout ratio sit at around 50% or less. But I think anything up to 79%, not too bad. At 80%, you got to raise an eyebrow. At 90%, that's when you want to pinch both your left and right nipples and start sweating because that dividend might not be sustainable going forward. And in the context of Lockheed Martin, their payout ratio is 45% right now, which means their dividend is absolutely sustainable. But it's not just the reliability of the dividend that I care about. As a dividend growth investor, I also want to see their dividend payout be growing year over year. And for the past 5 years, their dividend payout is growing at a rate of 7.2%, which I would argue is pretty darn good. For the dividend growth rate, what I like to see in a mature company is a rate that is near or above the rate of inflation. Historically, that's somewhere around 3 to maybe 4%. So to see 7%, it tells me that the dividend payouts are going to be above the rate of inflation, meaning how much dividends I get from them year over year is going to keep up with the cost of living and more. So I love what I see so far. However, I take it a step further. I don't just look at the dividend payout ratio, which is in the context of earnings in relation to dividends paid out. I also like to look at the free cash flow payout ratio. That way we can figure out if the cash that they're generating is enough to afford the dividend. And I think this one is more accurate and honest because when it comes to this number right here, you can literally play around and manipulate the numbers because it's based on the net income, the earnings. It could be misleading because they can mess around with the numbers, with like the depreciation rate, and it might not really reflect the cash that they have on hand to pay for the dividend. Whereas this one right here, the free cash flow ratio, it tells us, is the cash that they have that they're generating year over year, is that enough to sustain the dividend itself without any wonky accounting manipulation going on? And with that said, their free cash flow dividend payout ratio is 59.73%, which tells me that their dividend right now is safe. And it's amazing because they're growing it at a rate of 7% year over year. So dividend profile, I would literally label this in the S tier. And when we take a look at their company scorecard, I think it looks pretty spectacular. Even if you don't understand the business or the landscape, you should understand still that the dividend profile looks good, that it's slightly undervalued, and there should be a yellow flag raised for their operating margin and their net income situation because it was a one-off $1.8 billion expense. But will something like that happen again in the next quarter? In the next year? If not, you can kind of dismiss it and be like, okay, well, that was an extenuating circumstance that was just, happened out of nowhere. And so if you turn a blind eye towards that, I would say the financials and fundamentals, the valuation and trading multiple, and the dividend profile tells me that Lockheed Martin is a screaming buy. But then again, the question you have to ask yourself is it really? Is it really a good price? So keep in mind, right now it's $423 a share. Depending on when you watch this, it could be $415, It could be $440 a share, but as of right now, $423. So I did my discounted cash flow analysis model, and from that, I figured out an intrinsic value for Lockheed Martin, and that is $455 a share. So even through the DCF model, it tells me that Lockheed Martin is undervalued. However, I took it a step further because I want to benchmark and cross-reference whether or not they're truly undervalued. And so I ran the dividend discount model to figure out how much is the company worth through their dividend profile. And that spit out an intrinsic valuation of $699 a share based on a 6% dividend growth rate, which by the way, they're growing it at a rate of 7%. So I even deducted 1% to play it safe and be conservative, and that spit out $699 a share. My goodness gracious. And so with these two numbers right here, it tells me how much Lockheed Martin is worth based on their free cash flow and their dividend profile. And so what I like to do is average the two to figure out what is the price ballpark number that we are working with. So when it's all said and done, Lockheed Martin right now should be valued at about $577 a share. And when you heard that number, you might be like, dude, you're way too optimistic. You're an idiot. What do you know? You have small nipples, your hairline's receding. Okay, first of all, you're getting way too personal. 577, it might sound way too good to be true. However, when you think about what the Wall Street analysts are saying, those guys in suits and ties, they think Lockheed Martin is worth $552 a share. So at its current trading price, it's an upside of 30%. And when you think about the most bearish guy that is reporting and analyzing Lockheed Martin, he thinks that they're worth $497 a share. So even the guy who does not believe in Lockheed Martin at $497, even he thinks it's undervalued because there's an upside of 17% from its current trading price. I said 577, Wall Street says 552. And so my next natural question is, what price do I buy them at? Because if they make it through all of the criteria, checklists, and metrics, and everything is fundamentally sound and I feel comfortable, then I try to figure out what price should I be buying into Lockheed Martin. Well, I think, as I mentioned in my defense stocks video, I think the title was something like military stocks are on sale. I said that I would be personally buying or eyeballing Lockheed Martin if they reach $425 a share. And as of right now, they have finally reached that price point. So I would still maintain that status and that ideology. Lockheed Martin is undervalued and a good price to buy at $425 or around that ballpark. However, if you want to take it a step further, I think if you're able to pick up shares of Lockheed Martin when it's around $400 per share, I think you're getting a bargain. A huge discount and a really good margin of safety baked in, which by the way, the margin of safety goes side by side with value investing. You never ever want to overpay for a good company. When it comes to buying into a good business, you don't want to just willy-nilly just buy whatever price it is today. You want to buy that good business at a good price as well. And that's what we're doing right now. If I were to buy into Lockheed Martin with all of their fundamentals intact right now, their mission, the F-35, their scope, and war always being on the menu at $425, I would be a happy camper and I would sleep soundly at night. At $400 a share, dude, I would be smiling and playing with my nipples. I would be really excited at $400 per share. With all that said, at $399 or less per share, I think that's an absolute steal. So if I'm able to pick up shares of Lockheed Martin when it trades for about $380, $395 a share, dude, I would be so stoked, excited. Will it ever reach that price point? I don't know. So my personal game plan right now, I think out of all of the defense contracting and military stocks, I said it in the military stocks video, I truly believe that Lockheed Martin is the best, the highest quality, and the brightest future. However, up until this point, I started dollar cost averaging into Huntington Ingalls, which is a shipbuilder for submarines and carriers and destroyers for the United States Navy and United States Coast Guard. I was dollar cost averaging into them because I also think they are undervalued and at a very good price right now. However, to see Lockheed Martin finally reach the territory where I feel like it's a good deal, I am personally going to be buying shares of Lockheed Martin. That's my own game plan. Why do I keep saying my own? Not because because I'm selfish or a narcissist. It's because I truly want you to do your own homework and research to figure out whether or not you like Lockheed Martin. Just because I'm standing in front of you, butt-ass naked, no, I'm just kidding. I'm wearing sweatpants and a jacket. It's freaking freezing today here in Japan. I don't know why. It's windy, it's snowing, and it's cold. But anyways, I'm standing before you today with an honest heart thinking like, dude, this is actually a really good price for Lockheed Martin because of my own homework and research. I understand what this company is, what they're worth, and how they're on discount right now. I like it. I want you to be able to do that as well so that you feel comfortable and get a fuzzy feeling around your butthole. Not because you didn't wipe after you pooped last night, but because you feel confident in what you're doing. Your investing thesis is sound, the philosophy, the company aligns with your vision, your risk profile. Please do your own analysis. Please, don't just follow me into this. Please. And other than that, something you should know about me is I'm a huge sports guy, right? I don't look the part, but I love football. I love lacrosse. I love soccer. Yes, I'm an American. That's why I call it soccer. But I'm not really a fan of basketball or baseball. I can never get into it. Same with rugby. And I guess depending on my mood, if I'm angry, if I'm frustrated, then I like watching, the UFC and MMA as well. But anyways, the MLS, which stands for the Major League Soccer, the league is starting back up, and I'm pretty stoked. Because after the football season ends, it runs from August to maybe February, depending on whether or not your favorite team is playing in the Super Bowl. And then after that, you're just kind of dry, right? If you're anything like me and you don't like baseball and basketball, there's nothing really happening in the spring and summertime. But I fill in that void because as of the past 3 years, I've become a fan of soccer, which is really funny. Because I remember I was that douchebag growing up. I was so mean about it too. I used to call soccer players, foot fairies because a lot of my friends and my best friends, they were soccer players, and I used to tease them because I was a lacrosse and football player. I would be like, dude, you guys are foot fairies. And looking back, I was silly and I was just joking around. But now I'm a fan of it, which I think is hilarious. All that to say, the MLS is starting back up. The first game of the season for the Seattle Sounders, which is the team that I support, is going to be February the 22nd, and I'm really excited. And I hear you already, right? I also watch the Premier League and the Bundesliga, and I agree. The MLS, the quality is not up there, okay? However, I think that the MLS could probably, the best teams in the MLS, when I think about Inter Miami or Seattle Sounders, I think they can go toe-to-toe, nipple-to-nipple with the championship or the tier 2 of the Bundesliga. I really do think the MLS quality, people make fun of so much, but the players and the tactics, the strategy and the coaches, everything about it is improving year over year. So if you've never considered watching the MLS, I think this season right here is a really good opportunity for you to get into it. And I invite you to be a bandwagon fan to the Sounders, but to be honest, you would probably have more fun watching, Lionel Messi's Inter Miami team because he has the old school Barcelona squad with him down there. But give it a try. I think soccer's pretty dope. Which is kind of funny because, you're lucky to see maybe 1 or 2 goals a game. But once you understand the tactics, the strategy on why the goals are not happening left and right like it does in basketball, you start to understand why we call it the beautiful game. Anyways, I'm pretty stoked. Besides doing research in the stock market and analyzing companies, I really love watching soccer, so I'm pretty excited. Anyways, I love you guys. Thanks for taking the time to watch this video. Hopefully you learned a thing or two. If you have any pointers or metrics that you really care about, let me know in the comments section because I can absolutely revise my scorecard of the metrics and the checklist that we went through here today. And if it's in your heart, your tiny little heart, if you have some love for a middle-aged Korean guy making content about the stock market and you like what you see here and you appreciate it, why not hop over to the Patreon and become a supporter? If you don't want to or don't think I deserve it, it's okay. I still love you, man. Stay safe, and I'll talk to you really soon, my man. Peace.